There you go. That's useful. And does it have the charts? No, it still doesn't have the charts though. All right, I give up. Anyway, so this is pretty much the way the markets are looking at the moment. So it has, well, oh, look at that. I can even make that small. That's interesting. Let's do that then. All right. All right, so look, we're drifting along. We were this high yesterday, we're this high today. We went to the top here, and now we're down here. And yesterday we bottomed out here, and we're bottoming out now. So it's all the frickin' same, okay? There you go, nicely summarized. Everything's a frickin' same. It doesn't matter. It's an illusion if you think that something is happening. See how they look over here. This is just drifting along. That's what we're doing right now. If you're drifting along. See how everything's like flatlining basically. I mean, yeah, making a little bit of progress, but generally flatlining. Nothing to get excited about. All right, so we're waiting for information. We're waiting for news. We're waiting for something to happen. Look at Bitcoin. Bitcoin's down 5,000. You know, and again, this goes back to why it can't be a currency, okay? I mean, the dollar's bad enough. The dollar is up almost 1% in a couple of days. Bitcoin is down like 5%. You know, 109 to 104 is one, well, not really 5%, but whatever that looks like. But I mean, that's not a currency. You can't. You know, here's the thing. If I'm reading the paper, and I not that anyone does that anymore, but if I'm reading the paper and I see that the new Mercedes is $60,000, and I go, okay, good, let me take $60,000 out and buy the Mercedes. So today I go to my bank and I take out $60,000 and I go to buy the Mercedes and I get it for $60,000 because that's what it said in the paper. Okay. Now, on the other hand, if I read the paper and I said, "Ooh, $60,000, I need, you know, whatever. I need a Bitcoin or this much of a Bitcoin." But then by the time I go to the dealership the next day, it's $66,000 or $63,000. Now I need $3,000 more dollars. That's not how commerce works. You can't plan your life based on a currency that moves up and down 5% by the time you go from the bank to the store or whatever, you know. I mean, it doesn't make any sense. You never know what things are going to cost. You know, the point of money is the stability. And in fact, I remember back when I was in college and I was in Italy, and their inflation was so bad in Italy that everything in the restaurants was written in chalk. Like the menus were all chalk, and they would just change the prices. Like while you're sitting there, they would change the prices. I mean, it was crazy because you couldn't count from 1 second to the next on how much the money people had in their pockets was worth. And it was freaking madness. These were lira at the time before they had the euro. So it was complete madness. It was just like, it was just a made up number, whatever they wanted. You know, but we had dollars, so it was also laughably low. We didn't care. But imagine if that was your currency and you got paid in that, and you would have to basically be negotiating with your boss every day on how much you should get paid. Because he would tell you, "Oh, I'm going to pay you what I paid you yesterday," and you'd be like, I can't live on that. I need more money. I need 10% more today because I didn't get paid." That's what Bitcoin is like. It's useless as a currency. And not only that, though, it's incredibly difficult to transact with. So, you know, there's all these protocols and handshakes, and it's subject to all sorts of, there's a million ways to scam it. It's just awful. But anyway, but these stable coins, which you talked about last week, are the thing, because those are backed by dollars. Well, and there's two kinds of stable coins. The Congress is just passing a thing to allow them to be used in banks. There's two kinds of stable coins. There's USDT, which is kind of slipshod and bullshitty. USDT, slipshod and bullshitty. Okay, so remember that with the T is for bullshitty. And then there's USDC, which is approved by Washington, D.C. So there's USDC. They're both being approved, and that's a stupid thing. But there's too much power in the USDT people to get rid of it. But USDC is the one that goes through BlackRock and Bank of New York Mellon and Coinbase. So all the biggies are involved, and it's all been handled very transparently. And what it means is basically, essentially, there is $1 backing every single USDC. So a USDC is effectively a dollar, in as much as a dollar bill is a dollar, because what's backing a dollar bill? Nothing. So what's backing USDC? A dollar bill, which is backed by nothing, but at least it's backed by a dollar bill. Whereas USDT, okay, with the T standing for bullshitty, is kind of sort of backed by dollars. Like, they seem to have maybe 75% coverage, blah, blah, blah. Well, that's kind of weird. That means if you're giving them $1 for USDT, then when push comes to shove, if everybody liquidates, they're only going to get 75 cents back. That doesn't sound good. And even then, the thing is, there could be a run on the currency. So the currency is not adequately backed, and if somebody shorts the shit out of it and causes a panic, and they can't re-dollarize if everybody wants to turn their USDT back for dollars, there aren't enough dollars to support it, then the whole thing can collapse, and they would be forced to shut down the exchanges, and everybody would feel like their stuff is worthless. That would be the time to go in and buy, but people would be panicking out of it, just like a stock crash, because it's in that and the money's gone. The money that was put in was used by the creators of USDT to enrich themselves. So it is a bullshit currency. If you're going to take in billions, hundreds of billions of dollars, and your concept of the currency is that you will skim 25% off the top of the money that comes in, you will become very wealthy. It's a great scam, and that's a scam of Trump coin also. It's the same thing. So they just looked at and not only Trump coin though, but there are many financial instruments that are being backed by USDT or written on the same protocols as USDT, because everybody's like, whoa, what a scam. All you got to do is get people to buy your stuff, and it's like giving you money. So you don't want to be involved in that. USDC though, so be careful, because they're both coming out at the same time. There's going to be USDT and USDC. And don't do any sub ones. I have people calling me all day long. Oh, should I do this? It's a sub of USDT and it's supposed to be really hot and this guy's endorsing it. No, the actual USDC is the only thing you want to be playing with. And it's not even, and again, what do you need it for though? Why don't you just use dollars? Why are you trading your dollars for USDC so you can transact with USDC when dollars work just fine, and so do Visa cards and so on and so forth? But now you look at Visa and MasterCard. This is big stuff too, by the way. It's not like a little thing. You look at Visa, and what's happening? Their stock is selling off like crazy. Why is that? Because this USDC, this digital currency, is going to be used, like Walmart is going to use a USDC-backed system to encourage people to use it to buy things at Walmart. So there's going to be a Walmart card that's using the USDC protocol, bypassing Visa and MasterCard. That's not good for Visa and MasterCard, is it? And a lot of people are going to start doing that. It's like a new form of transactable things. And why USDC? Why didn't they do this with Bitcoin? Because Bitcoin doesn't transact cleanly. Because Bitcoins, you break everything up into Satoshi, and you have to have all these protocols and handshakes and this and that. And it's like remember, like 20 years ago, if we used a credit card terminal, sometimes you'd be waiting like a minute and a half, 2 minutes, and the guy behind the counter would be like, I don't know, it's very slow today. That's what Bitcoin is like when you try to use it. It takes forever to get the protocols going, because it's very complex, and it's very and it's very hackable. Also, is another problem with it. So you don't see it being used for transactions on a regular basis, whereas USDC is basically as fast as a credit card. It can transact pretty much immediately. And why is that? Because each coin is unique. See, this is the thing. Each coin is unique, and each coin is backed by a US dollar. So there is $1 for every coin, and therefore every legally authorized or legally created coin is worth $1. And if you take your dollar back, your coin is destroyed. As long as the coin is not destroyed, and as long as the dollar is deposited, once the dollar is deposited, a coin is created. And that coin could be, imagine it's called fill number one. Coin, I give them $1 and I get fill number one. If I give them $1 million, I have the numbers fill number one through $1 million. It's identified specifically to the transaction where it went in, right? Now, if I then buy stuff with my coins, then you might have 200 fill coins, fill number 100 to 200. Somebody else may have fill coins 201 to 900. Whatever I pay for stuff, I'd be paying with my fill coins, but those coins would all be backed by a US dollar that I originally put in the bank. By the time you then give fill coin number 305 to a valet for a tip, and he's got 305. It doesn't matter though, it just goes around and around and around. Now, if anybody ever takes fill coin 305 and puts and asks to get $1 for it, what happens? They are cheerfully given $1, and the dollar goes in their bank the way any dollar would. So it's a clean, direct substitute for money, and it's really just a proxy for money. The same way your credit card is a proxy for money. When you do a transaction, then money is allocated from, or not money is allocated, but money is, a bill is created personally to you on your credit card statement, right? Your credit card company creates a bill to you on your credit card statement, and they will bill you at the end of the month. Now, keep that in mind. They're doing a float. They're floating you for they're floating you for like 30 days on the money. Now, if they love to, they'll charge you interest and crap if you don't pay. But it's the 30-day float is free. Whereas a stable coin, it's the opposite. You're paying them, you're giving them $1, and they're giving you a made-up coin that costs them nothing to make. Okay, so you're floating the stable coin companies the money. That's why they love it. That's why Walmart loves it. It's like using a debit card. Basically, when you're with a vendor, you're using a debit card. It's cash. As far as they're concerned, it's cash. You can't default. You can't not pay. Nobody has to chase you for interest. Nobody has to worry about your payment being late or something like that. None of it. It's you're just using a debit card. You already gave them the money. It's the legitimate money that's been paid into their system in exchange for the stable coin. So in advance, now it's up to you to spend it. And think about, it's just like gift cards. Think of how many people have gift cards that they never use. You paid for the gift card and you forget to use it. You put it in a drawer, you say, I'm going to get to it one day, blah, blah, blah. It's like that. The float of money that's going to be held by the stablecoin companies is enormous. And not only that, but there will be people who will never, or who will forget to use their stablecoins. They'll just be sitting around. And that's glorious to them. They're just collecting interest on your money. You're foregoing your bank interest to have the stable coin for what? And again, for what? What are you doing with it? But what it's going to be is Walmart is going to, I'm not sure if there's going to be anything about it, but Walmart stable coin. Oh, somebody asked before me. La da da. Amazon and Walmart. I mean, that's 20% of all the retail in the United States. That's a big deal. What Amazon? Oh, here you go. Maybe that's helpful. Although maybe not. This Dario AS. We don't know who he is. Ugh. Disagree at all. There you go. Instead of paying Visa MasterCard, customers use retail-backed digital coin. The whole thing here. All right, anyway, so the gist of it is what I said. I'm not going to get, I mean, I don't want to make it a whole webinar about what stable coins are, but we talked about it in very much detail last week in one of the posts. I forget which one. Ew, that doesn't look, no, that's a blueberry. I don't know, it just looks kind of bad. So anyway, so there'll be incentives like 1% back, you'll make 1% or something like that. Of course, because Amazon and Walmart, they are paying, I would say probably 2%, 1.5% processing fees, because of course they negotiate fees. They're paying 1.5%, 2% processing fees to Visa and MasterCard. So they'd much rather have, they'd rather give you 1% and incentivize you to use stable coins. And again, it goes back to there's no waiting. They don't have to wait. They don't have to, there's no clearing period. It's like cash for them. So it's going to be very different than Bitcoin. And it's going to be actually a thing that gets used. And now we should say, oops. Senate passed a stablecoin regulation bill. So, I mean, the Senate had bipartisan support and Trump wants it to go through, so I can't see how the House is going to drop it. The Genius Act. I love the names they come up with now. Establish a regulatory the framework for the stable coins. 68 to 30 is a pretty big pass. Because the nice thing about stable coins in this case for us, for America, is that they're still backed by dollars. So if people are trying to move away from the dollar in other countries, but if we can get them to move to stable coins that are backed by dollars, it may not feel like the same thing to them, but it is going to be essentially the same thing. So they'll still be using dollars. They'll just be using a dollar proxy. It's like putting some paint on it. I don't see much, nothing of substance there. Okay, anyway, so it's very important to know because it's happening, and it's also the most important message I have, though, is there are a billion scams. I can't believe how fast there are scams with these things. So be very, very careful. Wait until things settle down a little bit, and there's no magical way. That's the thing, all these scams. There's no magical way you're going to make money by investing in stable coins. The whole concept is that one stable coin is $1. If one stable coin isn't $1, it's a scam. Therefore, anybody who tells you that if you invest in this stable coin now to get ahead of everybody, blah, 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 that's bullshit, okay? It's all bullshit. Okay, think of it like that, like a $200 bill is coming out, or let's say they're issuing a $500 bill with Trump's face on it or something like that. And because with inflation, a $100 bill isn't really useful anymore, is it? It's like 20s. I used to have fives in my wallet, right? I would have 20s and I would have fives and I would have one emergency 100. This is going back 20 plus years, but that's what I used to carry in my wallet with me. I would have, maybe 10 20s and 10 fives and, and $100 or $200 in my wallet just in case of an emergency. So I'd have about $500 on me. Now I've got $500 as my emergency money, and I've got a couple of hundreds and some 20s. I probably have 1,000 on me at all times. It's crazy, and frankly, I don't even use cash anymore, so I don't know why. I mean, there's no real point. But no fives. I don't have fives. I have 20s. I always had 20. As soon as I have less than a 20, I get rid of it somewhere. I put it, I come home, I just throw it in a thing and take it to the bank. I mean, anything, you hardly have many things that cost less than 20 bucks these days. So it's just a real big difference. So anyway, so 500 would be a legitimate bill. But again, the point would be that if you knew they were issuing a $500 bill for fact, and somebody told you should get ahead of the game and they're going to get you these $500 bills, or if you get them now, they're going to be worth $550 soon, and you should pay $500 now and give it to this guy, and he's going to get you the money and whatever. It's all bullshit. You know that's bullshit because it makes no sense. You're like, why would that happen? It's a $500 bill. I exchanged five $100 bills for it. That's how money works. Well, that's the same thing as a stable coin. A stable coin is a dollar. It's just a different form of a dollar. You cannot make money by getting ahead of it or getting in front of it or hoarding them or anything else. It's a dollar. It's a digital version of a dollar. That's all it is. All right, because again, I'm telling you, I'm saying this because I have had dozens of phone calls from people I know asking me about these scams. It's like unbelievable how many scams there are, and the more into finance you are, and like that thing I just said, reject all cookies, the more things you go to and accept cookies and leave your footprint around, the more they know to target you for this sort of thing and come after you and say, yo, you're a guy who might fall for this. So be real careful. That's all I have to say. There's a lot of words to just say, be real careful out there. But it is important because the whole financial system's changing. Like I said, look at Visa. I mean, they don't think this is a joke. 371 to 340, that's 10%. Here's MasterCard. And this is just the beginning because people are going to start doing the math on these poor bastards. MasterCard's just as bad. 589 to 546. That's also 10%. I don't know what. I think people thought it wasn't going to pass or something. It was definitely going to pass. There's no question about it. So, I mean, if you think that retail sales isn't all they do, not all retail sales is Visa and MasterCard, although probably a huge portion is, but it's certainly going to be impactful to their total business. And there's no easy way to look at them and figure out what it is. I mean, I guess I can run the bots on it and figure out what it is. But I should have thought of short. I didn't think of shorting them. That would have been a smart play, actually. It's kind of obvious that was going to happen. Where's my thing? Damn it. Stockopedia. Oh. That's why I didn't have a symbol. Oh, stop it. I don't want more cookies. Everybody wants to do cookies. So you can't tell because if you look at MasterCard, it doesn't show you that this is nothing to do with the sales. This is the money that comes in from the sales. And the question is how much of their operating profit is, how much of this is a transaction cost and how much of this is a base, and you have to figure that out too. But if you look here, going from 18 to 22 brings them up to, it costs them 2 in operating. Here's 2 in operating to gain 3. Here's 1.5 in operating to gain 3. That's no gain. Here's their operating expenses going up anyway. Oh, that's the trailing, sorry. So it's hard to say if there's a direct relationship here, and it's also very hard to say that if this drops 10%, how quickly is their operating going to go back down? So if this goes down 10%, are they going to be able to shave the percentage of operating profit, or do they have a lot of internal costs that can't be pulled back because they're spending more on computers and more on people and so on and so forth? And if there's a sudden pullback, it'll be more like a recession like this. Look, see what happened here? They went from 16.8 to 15.3. So they dropped 1.5, and operating profit dropped 1.5 right away, and net profit dropped also 1.5. So it didn't drop fast enough to regain their net profit. Is a problem. And that could happen here, that if this goes down because they're planning for growth and they're priced for growth, because the PE of MasterCard is 33.2. And that's the problem too. So what if they shouldn't be priced for growth? They could be way, way overvalued, because if you think about this number dropping back to, let's say, 13, instead of going up to 16, if it drops back to 13, you're talking about the amount of money they made in 2024 and 5 years, 3 years. Let's try to see. So you're talking about the kind of money they made in 2024 when they were more like $100 cheaper. And they're not going to get that growth. And in fact, you can imagine all these ways in which different kinds of retail cards and stable coins are going to eat them alive. And that's why, in fact, JP Morgan just raised the fees, but they also raised the benefits tremendously in their Sapphire cards. They're adding a ton of new benefits. American Express is revamping their Platinum card with more benefits, because they've got their first line of defense. I mean, you know, what do credit cards really have? They got to find a way to keep you as a customer. So they're leaning on perks, and they're trying to find more ways to give you benefits that are going to keep you using the card. So these guys are in trouble. That's the bottom line. And it's a big deal. There's a $500 billion company. Visa's probably about the same, and they're in big trouble. So, but Visa's like $700 billion company. So they have much bigger numbers. But also Visa's at 29x. So this is going to be very problematic. There's a very big change in a lot of things going forward. So now we have a whole nother thing we're going to have to consider as we think about these companies. And do they have a lot of debt? Nah, they don't really have a lot of debt. I mean, that's $7 billion in debt is nothing when you're making $22 billion a year, right? So that's not going to be a problem for them. And who knows? They might align themselves with the digital currencies. But again, but will the margin be there? That's the thing. Can they make the same margin? Can they make the same amount of money as they lose control of the narrative? You know, but then you have to consider that they have their primary revenue base is what? Is their primary revenue base credit card fees? Well, that's what JP Morgan is doing. That they're trying to be more like Costco. They're saying, well, everybody needs a credit card, so we're not gonna make them sort of, you know, $175 anymore, whatever the hell they charge. We're gonna tell you it's $500 a year, because people don't seem to mind paying $500 a year. And we talked about that psychology. What with? I don't know. Last week we talked about something with that. So, well, there's Costco. Yeah, well, that's true. That's Costco's. We talked about that being Costco's advantage over Walmart, is that Costco is taking 2% in the membership fee. The 2% profit that Walmart makes on you, Costco's taking it as a membership fee, and therefore, when you go to Walmart and the 2% is not a membership fee, I'm not talking about Sam's Club, I'm talking about regular Walmart, but when you're comparing prices, it doesn't seem like much, but it is, because you're looking at everything is 2% cheaper at Costco, and you go, oh, Costco is cheaper by far. It's not cheaper. You pay them a membership fee. That's where the money is. It's just what they call a sunk cost. You already paid the 2%. You're not thinking about it that way. That's what the credit card companies are trying to do. They're trying to say they might offer more attractive loan fees in exchange for you paying them if you're paying $500 a year, they may say, oh, we're going to only charge you 12% instead of 18% interest. And you're going to go, oh, wow, it's only 12% interest. It's like, yeah, they charge you $500 already. And if you, and then, you know, it's like a gym membership. Most people don't use the interest. Therefore, they're getting a great deal. And of course, it jams right back up to 25% if you miss a payment. So that's in the fine print. So you paid him $500 and now you're paying 25% interest as well. Everything's a scam, right? It's awful. Anyway, what are we supposed to be talking about? We are supposed to be talking about portfolio reviews, and we're going to be talking about Powell in 30 minutes. So we better get on the ball here, right? Oh, see, last week Trump and Musk were making up. That turns out they didn't actually make up. They just stopped talking basically, and there's nothing seems to be going on between them. It's just, but the sniping is over, so that's nice. So today we talked about the Fed decision coming up, the war, the possibility that World War III is starting as usual in the Middle East. So that's nothing. In fact, actually, I just did this chart. This is a good chart. Let's talk about this. This is the it's always something chart. What? Oh, as usual, I am not signed in. So annoying. Well, I guess if I'm not on the thing for a week, it probably should have signed me out. So I guess that's probably working correctly. I'm always thinking in my head, I'm always like, I just used that, but I didn't just use it. I used it a week ago. All right, there we are. No, that's not it. Damn it. Where's the thing I used? Ah, how big can that be? Great. So this is back 5 years, 6 years ago, but it doesn't matter. I mean, the point is, it's it's always the same. It's like you think about all the stuff that happens, including constant wars in the Middle East, Russia invading Ukraine, blah blah blah. There's always something. And here's stuff that happened. This was a big crash, of course. So Chrysler and GM filed for bankruptcy. That was a big deal. BP had that oil spill that destroyed Florida. We had that flash. Remember the flash crash? We don't even worry about that shit anymore, right? It's like flash crash. That could happen any time, but nobody thinks of that. Europe had a debt crisis. We had the fiscal cliff. There was a taper tantrum with the Fed when they started tapering their stuff. The government shut down. We were worried about Ebola for a couple of minutes. The Dow fell 1,000 points for the first time in one day. We've had that happen like 5 times in the last year. But this was the first time the Dow ever fell 1,000 points. The global market sold off. China fell apart. Oil fell apart. I remember that. It was nasty. There was Brexit. That was chaos. Trump got elected. that was a bad thing. The VIX. Oh, the VIX hit a low. Well, who cares if the VIX hit a low? The Nasdaq fell 4%. The Dow had an even bigger decline that time. The S&P crashed again back in 2019. This is not even up to, we're not even up to COVID. Then we had COVID. We had another trade war back then. That was also Trump's, of course. The government shut down also. That was also, Trump had a fun term, huh? And Iranian bombing. Look at that. There was an Iranian bombing in December of 2019, right? And meanwhile, during this period, for over 10 years, the market went up 495%, which is including compounding, but realistically, you're gaining 50% a year in 10 years. And while all this crap is happening, and where are we now? I mean, it doesn't say it doesn't say the number, but I mean, obviously, we're up probably another. In the 5 years since, I think we're up another 500%. So, or 200%, something crazy. Well, here you go. Let's see if we can find it. Where's my futures? Oh yeah. So since 2019, we've gone from 25 to 6. So it's up 100 and whatever the hell. Wait. 25. It would be 5, and then 1 is another 40%. So it's 200. It's 200 here. It's 240%. It's going up at the same pace. It's even messier, but we are going up at the same pace. And if you look, it's kind of a sort of consistent line going up. So if you flatten this line out, it would pierce through that stuff and be up here, because this is 510 years and this is 240% in because 500 includes the first amount. So in other words, 100% is not saying it went up that much, it's saying it changed that much. And of course, that was handpicked because you started at the low of 2009. The reality is the market had been more like around, between 1,000 and 1,500, so say 1,250 was the reality. So not up as much as that, but from the low, incredible gains. So where were we? Oh yeah, we were going to look at the portfolios. But I just wanted to point out how insane. I mean, it's always something going on. So when you're looking at the market, you got to have the broad run perspective and say, hey, there's what we don't have that we used to have is a growing population. So we don't have the global population is not really growing very fast anymore. And there aren't really new trade empires to set up. And that's the thing to contract is like, what Trump's doing is he's disrupting trade. Population growth has already been disrupted. Trade is being disrupted. So your things that are lowering growth expectations globally are happening. And that's different than usual, but it's not going to cause the market to contract. It's just going to cause it to stabilize and flatten out. And inflation has been driving a lot of the recent market gains, and that also will flatten out eventually and stabilize. So we are going to get into a stagnant period. Now, whether we have stagflation or not depends on if we can work out all these trade deals and stuff, or if there are going to be constant shortages and supply chain disruptions that drive prices up, even when demand is not really going up itself. So there's a lot of ifs as far as what's going on, but you certainly can't count on like robust growth to save everything you do. But still, more or less, if you put money in the markets, it's going to be generally a good thing to do. And we combine that with selling options and using options to generate incomes and to leverage our positions, and doing that, since the only absolute certainty in the market is that all premium expires worthless. And if you can understand that and apply that to options trading, you will always be able to make money, because you become MasterCard. You're the guy charging 25% interest. You're the one that's raking it in, charging outrageous amounts of money to other people who want to play the market and think that they're going to be clever. Because it's really simple as a concept, because and this goes back to how we're portfolio building. But okay, trade all products. So, IBM. So here's IBM. Oh, wait, more things. All strikes. Okay. So IBM is $285. Okay. We think IBM will at least be $300, $15 higher in 18 months, in January 2027. So what do? Well, that's kind of big, right? Okay. So what do? Instead of buying the stock for $285, we buy let's say we buy the $250 call, which is, call it $64. All right, so 64, and we buy 10 of them, so let's say 6,400, 6,400. So we buy 10 of these calls for, I'm sorry, that's 64,000. $64,000. So we buy 10 calls for $64,000 at 250s. We said we wanted to go to three. We said we expect 300. So we sell these 3 calls for 38. So minus $38,000. So that's net $26,000. So we have the 250, 300 bull call spread, right? We netted in for $26,000. There's $24,000 of upside. So if IBM goes up $15, we make almost 100%. All right. I'm not even going to talk about selling puts. That's a whole nother thing that we talk about. But you could sell puts and lower the cost. So if I sell the 250 puts, which is still quite a bit out of the money, $35 out of the money, so more than like 15% out of the money. If I sell the 250 puts for $23,000, I'm going to net in for $3,000 on the spread. But I'm not even talking about that. I'm talking about very basically no margin, just doing a bull call spread. I will make 1,000 less than 100%. So, we'll get back $50,000 if IBM is at $300 in 18 months. All right. That's step 1. Step 2, I look at IBM and I say, okay, you know what? I don't think it's going to blast up to 300. I think it's going to grind up to 300. So right now it's at 285. Here's where the suckers are. I'm not a sucker because I bought a $50 spread for $26, and my $50 spread is $35 in the money. So I didn't pay a premium, I got a discount. I did pay a premium for the 250 calls because I paid $64 for the 250 calls. So I paid net $315. But then I turned around and I sold much more premium to this guy who bought the $300 calls from me. So I took my premium that I paid and I flipped it and immediately sold it to somebody else who paid more premium than I did. I rented out my stock, right? I rented out my position. So now I have the 300, 350 spread. The guy I sold to he's stuck. If he doesn't get to 330 or whatever, his was $30. If he doesn't get to 330, he makes nothing. If he gets to 330, I still make $50 more than he does. I still get back $50 more than he does. So I'm in phenomenal shape on the longs. Why anybody would ever not do this is a mystery to me. Knowing that this is possible, why would you do anything else? Why would I pay $285 for IBM? IBM would have to go to $570 for me to double my money. Whereas IBM only needs to go to $300 for me to double my money this way. And I'm laying out only $26,000. Whereas with IBM, if I wanted 1,000 shares, it'd be $285,000. So I'm taking 10% as much. I'm going to make 100% at 300 versus, not even 10% at 300 for IBM. And I also get to do this. I also get to go to September and say, okay, so I don't think IBM is going to be at 300 in December. So, but somebody is willing to pay me $11.35 or $11.50, let's say. Somebody's willing to pay me $11.50 for the 300 calls in December. So how much money do I make at 300? If IBM is 300 or over, I'm going to make $24,000. Yet I can take, let's say I sell 2 of these calls. Okay? So I've got 10 calls and I'm going to make $24,000. Okay, where's my calculator? All right, so I've got 10 calls that'll make 24,300. I'm going to sell 2 calls in September, and this is where it's better if I sold some puts too, right? Because then I would make the put money as well. But I would be more aggressive if I had the short puts, but then I'd have margin. So this way, I'm going to sell these, but then in fact, it's even better if I offset with margin. So let's talk about that. But to start with, don't forget IBM's at 285. September is 93 days away. I'm going to sell 2 September calls for $11.50. That's going to be $2,300 if I sell 2 calls. Now, $2,300 is almost 10% of $26,000 that I laid out. And I'm going to make that money in 90 days, 10% in 90 days. I'm paying myself effectively a dividend. Can I get burned? Yes. If IBM goes to 350, let's game that out. If IBM goes to 350, yes, I'm going to make my $24,000, but now I owe these 2 callers $50, $5,000 each, 10,000. So 10,000 of my 24,000 I would have to give back to the short callers. But I sold them for 20. I'm sorry, I sold them for 2,300. So I'm going to give back 7,700, whatever the hell it works out to. But you get the idea. So it's not going to kill me. It's just going to piss me off because it's going to eat into my profits, but not to the point where I'm going to go broke. So if IBM goes crazy, and again, but what if IBM goes to 800? Well, sure, anything could happen in the universe. This is why we hedge. But realistically, it's highly unlikely that IBM is going to go so out of control that I get burned. It would have to be over, what did I say, 350? It'd have to be over $400 at least before this thing really started to scare us to the point where we feel like we have to take action. And even then, there's ways to fix it. But let's not get into that. It's, there are ways to handle it. Let's leave it at that for further lessons. But what I'm saying is our basic thing is all we did is take $26,000. We bought a $50,000 spread. And now in the first 93 days, we're selling $2,300 worth of short calls. And you know what? I can sell these. I can sell the 270 puts that are on the opposite end, right? And those 270 puts are, let's say $10. That's another 2,000. So now I've sold, what do we say, 23 here and 2,000 here is, is $4,300 by selling the puts and calls. And obviously the puts and calls can't both get hit at the same time. One is going to win and one is going to lose. Or maybe, if I'm really lucky, both of them lose and I keep all the money. $4,300 divided by $2,600 is it is not. 4,300 divided by 26,000. 16.5%. So in 93 days, I'm paying myself a 16.5% dividend. And the $4,300 worth of premium I sold, because it's all out of the money, is absolutely going to be worthless. And like I said, even if IBM is up at 350, I would owe the $300 caller that the 2 calls would be $10,000. So I sold now, because now the puts are worthless. So I sold 4,300 and now I have to give back 10,000, but that means I only lose on my short call and put sale. I'm only going to lose $5,000, but I'm going to make $24,000 on the long. This is not a tragedy, and I can just go sell more puts and calls. And you know what? There's going to be 6 total chances, right? Each quarter. So there's going to be 6 quarters in which I'm able to sell $4,000 worth of premium. That's $24,000. That is as much money as I'm making on the spread if all goes well. So now I've doubled my potential upside, and the potential upside is now an insane 200% return if IBM goes up $15. And especially if it only goes up $15, because if it's only moving up that much over the course of 18 months, then every time I sell these puts and calls, I'm going to be a winner. And that's what it is. We want to play a stock that we feel is going to have a pretty flat trajectory over the next 18 months. We want to play a stock that we think will just sort of shamble along in a range. And so we're not looking for like a real bargain stock there. We're looking for a stock that's fairly valued. Let's see if we can do months. So IBM is certainly getting toppy up here. The fact that somebody's willing to pay so much money for 300, there's a lot of momentum people who believe that when they see this, it's going to go up forever. But I see that IBM is now 25 times earnings, and it's getting a little pricey. It's 50 times last year's earnings. It's 25 times their projected earnings. So while I have a lot of faith that IBM is going to be over 300, I don't think it's going to blast over 300 and get to some much higher number. And if it does, like I said, we'll take our loss and we'll wait until it slows down and we'll adjust. But you see here, it had this period here where it went from 72 to 195. That's I don't even know what the math. It's up almost 200%. So here IBM went up 200%. Of course, that's after a sell-off. But but this is kind of after a sell-off that we had into COVID. But this is after a very sharp sell-off that we had in 2008. IBM then was IBM, and of course I was banging the table on IBM back then because it's IBM, for God's sakes. IBM was our stock of the year, so it was, I think it was our stock of the year twice actually at some point. But it went up and up and up, and so what we do, so if we had it here, it would have jumped up. Then it flattens out. We would have made our money eventually back on the short calls, and then we get burned again, and we wait. And when the momentum stops, we start selling short calls again. That's fine with us. We don't care. We've got the long position. We're very happy. So, and I'm not saying me go. Let's see what Bodhi has to say about this. Yeah, I haven't looked at them in a while because we got them out. We finally dumped them. But it's like, that's way worse than I thought. Of course, it makes me want them, though. I'm not sure what's going on here. Jack in the Box have plunged 50% in the past year, setting 52-week low, 18 to 22. Is that right? Now it's more like 1750. Huh. All right, same-store sales fell 4.4, revenue dropped 7.8%. Loss for the quarter was 142 million, driven by a large non-cash impairment charge for Del Taco. Aha! That's something to watch. Though operating EPS was 120 above consensus. See, that's a thing people very, very often misread. So they did a non-cash impairment on Del Taco, which made them look like they had a terrible quarter, but they didn't really. So that's a good reason to get back in. Margins are compressed due to rising labor costs, food and quality, because they're very California centric company. They're in a lot of the West Coast, but really heavy in California, where I think it's like $20 an hour now for labor. Their long-term debt and lease obligations are $3 billion, exceeding its total assets of $2.7 billion. That's no good. Company's highly leveraged, $500 million debt maturity looms in early 2027. Management has suspended the dividend. Well, they should suspend the dividend to pay that off. And is selling real estate and considering Del Taco sale to pay for $300 million debt over the next 2 years. Okay, that is what they should be doing. Store closures and restructuring. They're closing 150, 200 unperforming stores, 10% of its footprint. I told them to do that because I had a conversation with Bodie, and I said, you know what, when you tell me something like that, when you say they closed 200 stores without the context, what good is it? It doesn't, then I have to go look up how many stores they had. So now he's telling me. Good job, Bodie. By the end of 25, as part of its Jack on Track turnaround time. Oh, I like that they named their turnaround time. The company's also exploring the sale of Del Taco, which is underperformed. Yes, that's true. There's shit acquisition. That can kill you. When you do shit like that, didn't we talk about that last week with food, or was I talking about that in chat? Anyway, food acquisitions and liquor acquisitions. We were talking about beer, right? So food and liquor acquisitions, it's really, people tend to think there's like a hot trend and they jump onto it and they say, oh, that company's doing great, blah, blah, blah. But it's just a niche, and things get hot and then they disappear and the fad fades out, and now you're sitting there with a freaking taco stand. I don't understand why they would buy Del Taco. It's such a weird purchase for me. So these moves are intended to streamline operation. Look how good he is. But they also signal distress and spooked investors. I just said that. Broader market industry, fast food sector is facing headwinds, blah, 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 blah. Jack's challenges are more severe than their peers. Bankruptcy risk. JC's bankruptcy fears stem from Jack's high leverage, negative free cash flow, and declining. However, there is no public filing, direct evidence of, well, obviously, the company is taking aggressive steps to avoid it closing stores, selling assets, spending. The risk is elevated, but management is actively working to stabilize the business. The next 12 months are critical. And if Del Taco, Jack is trading at a deep discount to historical valuations. The market cap is under 500 million, 7.4%. Some analysts see value if the turnaround succeeds. The stock could rebound. It's really stupidly off sale. I mean, it's crazy low. Same store sales. See, this is not good though. Same store sales minus 4.4%. Revenue minus 7%, but there's still, it's not like there's no revenue. Net income impairment charge. Debt, $3 billion. Store closures. Okay, and it costs money to close stores. That's the problem. Also, it costs money to close stores. That's gonna hurt also. Dividend suspended, yeah. Risk opportunity negative. Del Taco sale exploring, potential positive. Bankruptcy risk. I don't see who's gonna buy Del Taco in this environment. Jack, unless Taco Bell, wants to, replace it. Jack in the Box precarious position when stock is down sharply. Bankruptcy is not a certainty. The risk is higher than most restaurant peers. Turnaround plan must succeed to avoid further sell-off may be overdone. Okay. Oh, freaking Jack in the Box. Can't believe how they screwed up. So let's see what they're actually making. Wow, 332. Wow. So they're priced at 332. they're making $98 million, and that includes servicing their current debt. So, you know, they're still surviving, but it's down from 160, 116 was COVID, you can say that, but 131. So they should be at least in the 120s, 130s. This is really bad. Revenues are clearly off. They are making some huge mistakes. I mean, they're trading at 3 times earnings. It's so sad. But look at the debt. $1.7. It'll take them 20 years to pay off their debt. So no, this is not good. All right, so let's get back to what the actual question was. So you're in at about $35. That's a tough one. I don't think their options go out that far. I think that's another problem. Let's see. Oh yeah, no, they don't even have long options. So you're in for 35. You can sell the 2250 puts for 690. I'm trying to figure out if this is even worth doing. So let's say you have 1,000 shares. So let's say if 1,000 shares, $35,000, right? If you convert your shares, and don't forget this is only December, but if you convert your shares into $20 puts at 450, right? So you could sell 20 times 450 is 9,000. You could cash out of your shares, right? Which is $17,500. Cash out of your shares. Then you sell the puts. And so now you've collected 17,900 plus 9,000. You've collected $26,500 against your $35,000 assignment. And what's your risk? Your risk would be being reassigned 2,000 shares at 20. So you'd be back to 40,000. But in other words, if you're in for 35,000 now, and you can collect $9,000, you can cash out, take 17.5, put it in the bank, take 9,000 from the short puts, put it in the bank with you. You have $26,500 instead of $17,500 if you just get out, right? And then you risk being reassigned at $40,000, but then you'd have 2,000 shares, and you could then sell calls for $8,000, right? The 1750 calls, which are at the money. You could then sell calls for $8,000, and you drop your basis further. So then that would be like collecting the whole $35,000 back in the cycle, yet you'd have 2,000 shares. So if you want to stick with it, that might be the way to do it. Okay, so now if Jack bounces right back up, you may only get back the 17.5 plus the 9,000, it's 26.5, but that's still better than where you are now. If you just cash out, you're at 17.5. So, and especially because it's December, and by then there'll be, you know, March and maybe July calls next year, and you'll be able to sell more puts and do whatever. If you want to stick with it, that's how I would do it. Just take your longs off the table and risk being assigned again. So you're effectively doubling down, but you're collecting money up front to double down with. And then see how that goes. That's if you want to stick with Jack. Otherwise, it's like, there's other things you're going to be able to do with your money to double it up. It's not like there's any fixation on Jack. And frankly, I wouldn't get back into it right now myself. I mean, just as a, coming in fresh for cash, I have no reason to. It's going to be a long turnaround for them, and it sure ain't going to happen by December. You still need them to get back to 20 by December, but I do think this is an overreaction. So that's where I am with that. I think there are other ways to take your money and deploy 17,500. I'm now making that up because I don't know how many shares you have, but to redeploy $17,500 and to get back to 35,000, there are obviously other ways to do it. We just talked about how you can do it with whatever that trade was. What were you looking at before? I forgot, but whatever stock we were just looking at, where I gave you an example, I was like, oh, it was IBM. So, you can do an IBM trade, and I'm like, look how easy this is. You can easily double your money, easily. And it's IBM. It's not going bankrupt. They're not having problems. They don't have cash flow issues. They don't have debt issues. So, there are certainly other things to look at besides that. But those options have really good premiums, so it's not the worst thing to play. A little wishy-washy. I could go either way. All right, so we're not looking at that. Oh God. 2 o'clock, did the Fed just have their rate decision? Will you guys let me blow on about this? I didn't even get Warren ready for this. All right, one thing at a time. Fed. Hello. Good God, I missed the whole thing. All right. Sure, it's not going to be a big deal. Well, wait, what do the markets say? Oh, active trader, that's where it was. Hello. There we go. Up. We had an up and a down. Interesting. Okay. So statement. Oh my God, I'm going to do this myself without AI assistance. All right. Although swings in net exports have affected the data, that's their statement. What a weird way to start. Recent indicators suggest economic activities continue to expand at a solid pace. Unemployment is low. Well, that's the end of Trump. Then they're not gonna give him what he wants. The unemployment rate remains low. Labor market is solid. Inflation remains somewhat elevated. Oh wow. Is that seriously today? All right. Wow. That's such a slap in the face to Trump. Committee seeks to achieve blah blah blah. The uncertainty about the outlook has diminished but remains elevated. The committee really, they're going to say that in the middle of a potential giant war? All right. In support of the goals, the committee has decided to maintain funds at 4.5 to 4.25 to 4.5%, considering extent and timing and the range of the funds. The committee will carefully assess the data. The committee strongly committed to supporting blah, 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 and assessing the appropriate monetary policy. The committee will blah, 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 and blah, 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 and blah, blah, blah. Well, so they said nothing, and the rest is going to be all about, the dot plots and all that. So now, Mr. Computer, if you please. Oh, I can't do this. Warren. Okay. That's not Warren. What's going on here? Oh, I'm not logged in. Why is everything so slow? Now that's my next question. Hello? Oh, you gotta say which one. Oh, wait. Oh, that's his beige book. Oh no, you're the one I want to talk to. Fed statement. Oh, wait a minute. Oh, really? I don't think so. Shit. Now you all went to blanks. Beige book comparison, statement comparison. There you go. What's happening? What is all this? Federal Reserve, May 7th. Here you go, Fed statement. Fantastic. Okay. May 7th statement. So we already did this with him. Oh no, it's June. Oh, I see it. And refresh this one. There's no good way to do this. All right. If I can take this off, and I can then make this smaller. There we go. Now I can put them side by side. Okay. And where'd Warren go? Oh, stop it. Oh my God. Okay. It's June 18th, and here is the new Fed statement. Give us a comparison. And analysis, please, colon, do. All right. All right, key changes. Economic activity continue to expand at a solid pace. Economic activity continue to change something slightly more positive on labor, remains low instead of stabilized, signalizing ongoing strength. Outlook uncertainty. This is the biggest change the Fed acknowledges, lessening uncertainty. I don't see where they're saying that though. Inflation remains somewhat elevated. No change. The Fed sees inflation above the target. No change, no change. And this is more neutral and balanced. The biggest shift in the change from uncertainty is increased further. This acknowledges that the initial trade and tariff. Okay. This acknowledges that the initial trade and tariff shock policy whiplash that hit the markets in 2025. It also reflects the recent China-US trade meeting progress, which has reduced the worst case trade fears. Labor market remains strong with slightly firmer language, now saying unemployment remains low. No signs of immediate policy easing or tightening. That's why the market went down. Powell and committee remaining patient. Inflation remains somewhat elevated. Tariffs are still lingering in the background. Powell made it clear at the last meeting that full effects of the trade policy balance sheet reduction continues. They're still passively tightening QT. Markets have been pricing in 2 to 3 cuts, but the Fed continues to give no concrete signal for cuts. Today's slight softening of uncertainty language may give markets some hope for a cut later this year. Powell is still very much in the wait and see mode. Fed is clearly watching for clear data shifts on inflation, labor market, and consumer spending. No mention of the war at all. I can't believe it. Volatility remains high. Patience is warranted. Policy flexibility is on the table. Key data releases, the bond market signals are betting on eventual cuts. The Fed is moving to neutral watchfulness, and it's guardedly neutral now. The Fed is effectively stepping back from the edge of policy concern, but remains highly cautious. Very good. Okay. Please go over the Fed data and give us your overview for the second half of the year. Okay. And then we should be able to just take these, should be able to just give them this. No, what? Add photos and files. Connect Microsoft, connect Google Drive, add photos and files. Oh, okay. I don't know if that's going to work. No. So I have to first save the PDF, download, this PC, documents, this PC, documents, Fed, June 18, 2026. Okay. Oop. Here it is. This is just unbelievable that you can do this now. Excellent. Now that we have the full data set. All right, so we're done with you. And we're back to that. Federal Reserve has kept the funds rate steady. Is widely expected, but this means signals settled, but important shifts. Economic growth is slowing, but not stalling. Inflation remains elevated, but is projected. Uncertainty still elevated. The Fed remains in patient pause mode. Tariff, trade policy remain wild cards. The Fed is signaling that incoming data has reduced some of the tail risks they were previously concerned about. The sentence, risk of higher unemployment and higher inflation. So they don't believe in this anymore. The sentence was removed, suggesting the Fed sees those dual risks are more balanced today than 6 weeks ago. So they are less concerned about stagflation than they were. So really the market shouldn't be selling off on this. It's kind of fine. It's just that, Trump's going to have a little tantrum about not getting his rate cut. But, as I said many, many times, the Fed can't just cut rates. Trump is like blathering on today about the Fed needs to cut rates 2%. And if the Fed cuts rates 2%, that will save us $800 billion a year in interest on the debt. And yeah, that's true. Those things are true mathematically. But in reality, if the Fed cut the rates 2%, nobody would buy US debt because that's not a fair price for US debt. And then we would immediately go bankrupt and the country would be destroyed. So, Trump's insane and what he wants to do is insane. And the real danger here is that he's gonna pick a Fed chairman next year because Powell's done in March next year. So the real danger is that Trump is going to pick a Fed chairman who's going to actually do that. We are borrowing 700 billion, 800 billion, whatever the number is now. We're borrowing that much money every single month. And when you are already $37 trillion in debt, and you want to borrow another $2 to $3 trillion this year, just so you can service your debt and continue going deeper into debt, then you have to understand that the people who would be lending us money may start at some point saying, gosh, that doesn't seem like a good plan. And now you want to say not only that, but we want you to lend us some money at 2%, 3%. Because we're what, at 4.5 now. So we're at 4.5. Trump wants them to cut it to 2.5%. Nobody's going to do that. The Fed will lose control of monetary policy. It'll become ineffective, which, may be what Trump wants. He loves chaos and tearing down institutions. So, maybe that's the plan, but it's not a good plan. It's not a good plan for any of us. There's no single greater danger to America's monetary system than what Trump wants the Fed to do. All right, so updated projections. Look how nice Warren's charts are. You guys don't get to see that. All right, let me see. So GDP has been revised down by 3%. That's a lot. There's a 20% downward projection in GDP. For next year, only 10% lower projection for next year. Unemployment is a little bit higher, but nothing scary. PCE, 10% higher, and the Fed's acting like that's all fine. And this is without tariffs kicking in. Actually, I'm sorry, that is their projection, so it would include tariffs or what they think tariffs are going to be. Core PCE, 10% higher than it was. Fed funds rate, 3.9%. There's been no change. So that is 2 more cuts. Growth expectations have cooled slightly. Fed is forecasting inflation gradually gets back to target by 2027. The Fed maintains rate cut expectations only modestly lower, suggesting fewer cuts coming than the market has been pricing. Yeah, end of 2025. Powell's recent tone, while today's statement avoided mentioning trade tensions directly, trade and tariff hikes surveys show weakened consumer confidence, labor markets remain healthy but are cooling, inflation is moving kind of sideways, and the Fed believes that the current policy is modestly restrictive. We are well positioned to wait, putting it all together. The Bayes case. Growth, slow but positive, labor market softening gradually, inflation, gradual disinflation, policy, cuts are on the table for late 2025 or early 2026. Big risk to watch. And now they had this morning's data. It's not like they didn't have it. They were sitting there in a meeting today before they wrote this. Big risk to watch. Trade policy shocks. New tariffs remain, because the housing data was terrible this morning. New tariffs remain major upside risk. Geopolitical tensions are still fluid. No mention of the war. That's amazing. Declining confidence should accelerate demand slowdown. Corporate credit quality is holding up, but the spreads bear watching. Financial markets with the pause may continue to price more cuts than the Fed is projecting, increasing potential volatility. Implications, equities. Neutral to moderately positive near term, but fragile if consumer weakens faster or trade tensions reignite. Valuations remain elevated, which is exactly what I said. Fixed income, rates are stable near term, curve may steepen modestly. Inflation projects, long bonds are still attractive. The dollar range bound Limited upside. Inflation hedges are still valuable given the geopolitical backdrop, and volatility is likely to remain elevated on trade policy headlines. My personal read, okay. We have moved from stagflation fear to sticky disinflation with fragility. The key shift in today's statement is while risks remain, the Fed sees some diminishing tail risks. They are cautiously optimistic, enough to bring but not so that it risks a hard landing. Yet the markets continue pricing in multiple cuts may be premature. For now, Powell is staying in data-dependent pause mode, which markets tend to initially like, but may become frustrated if inflation progress stalls. If you'd like, I can prepare blah, 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 blah. Okay, so that's good. All right, good job. Wow, very pleased. All right. Do that, copy that, and which way Wednesday? That's right, that's one we should be in. Here you go. Mr. Warren. Oh, such hard work. Oh, his emojis are broken. I see. I wonder if this will work better if I pasted it the other way. Let's go back. I want to see if it comes out better. Yikes. Nope. Oh, but at least it doesn't have all the crap. All right. Or does it? Nah, it's too messy. I'm gonna have to fix it later. Huh. It looks so nice when he does it, but it's like I can't transfer it over. What is this? Federal Reserve statement comparison. Okay. Oh, Powell's going to speak in a minute. Hang on. There he is.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective.
All right, so this will track what he's actually saying.
Today, the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP, as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected.
I don't know what the markets are happy about with that.
In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation.
The 5 years,
Overall, a wide set of
3.96%.
indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment.
The 10 years,
The labor market was
4.375%.
not a source of significant inflationary pressures. The median projection.
30 years,
for unemployment in the SEP
4.882.
is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal.
The indexes are about a third of a
Consumer
point.
Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May. And that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal.
Still projecting 2 cuts in
The median
2025.
projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to.
Nobody's talking about the war.
On economic activity. The effects on inflation could be short-lived, reflecting a one-time.
Well, I'm talking about energy prices here.
It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully in prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without
Penny's right about that.
we cannot achieve the long periods.
We believe current policy is restrictive enough to contain inflation, but we will wait for clearer
We may find
data.
ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year, and to 3.4% at the end of
3.9 this year is 2 cuts. 3.6 next year
individual forecasts
is 1 cut, all of next year only.
uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of the
S&P is right at 6,000 at the moment. It's actually drifting lower.
Assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy, strategy, and communications. Our review includes outreach and public events.
Oh, there it goes, 599.
Parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining.
He's saying we don't have any idea. How about you?
Implications to our statement of long-term goals and monetary policy strategy by late summer. After that,
Trump has an idea.
Enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations.
He's talking about a 2% goal. They're at 3%.
And delivering on these goals matters.
And it went up since last
We
time.
understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
That's it. All right, so the rest is going to be Q&A.
To what extent has the more limited?
Although actually you get more out of the Q&A than you do out of the statement, because the statement was nothing we didn't already know. All right, so let's give it a bit, and then we'll let Warren digest some more of the Bloomberg stuff, but that seems to be about it. So I don't know. I mean, Trump's not getting what he wants. He's going to curse Powell out. But the Fed is just basically holding everything steady. They're still, the good news is they're still doing 2 cuts this year. And we've only got, we have 4 meetings left. So at 2 of these 4 meetings, they're expecting to cut rates. They probably won't do it in July. We didn't think they were going to do it until September anyway. So now they're saying out of 3 meetings possible, well, this was already there, they will also cut in October or December. So if they're going to do a cut in September, then we can expect another one before the end of the year. That's right back where everybody was hoping it was going to be. So I don't think this is a bad situation. And we'll have to see what happens. So now we can get back to the portfolios in all of 20 minutes. But we'll get back to, now we can get back to discussing like how to make money during all this. So again, the market should be pretty much flat going forward. 6,000, if all stay, unless anything bad happens, we should be able to maintain at, even 10% is only going to go down to 5,400. So you're in the 5,400 to 6,000 range for the rest of the year. There's nothing wrong with that. And there's no reason for us not to invest given that situation, because we're going to buy stocks that are worth investing in. I mean, look at this. Home Depot still down 7% from the highs. Lowe's is down from the highs from last month. Lowe's is down 8% from the highs. Tesla just gained 7% back today or something, or maybe it's $7, but whatever. They just gained back today. Apple, of course, we love Apple, so there's plenty of good things to buy. We're not hurting for things that we can pick up. Here's our Intel is down there. Berkshire's on sale still. As we said, Visa, MasterCard, I would stay away from. Progressive Insurance is nice and cheap. We'll see what kind of hurricane season we're looking at. ISRG, why is ISRG cheap? I was just watching a remote surgery thing that they did. It's amazing. Yeah, well, they're not cheap. They're just cheaper than they were. Wow, 50 something. Yeah, it's an incredible company. I mean, if you want to be a long-term investor, I mean, you can just buy them and wait, because what happens is they've already got the machines, right, in all these different hospitals. And they're only approved for certain types of surgeries. They have to keep getting themselves certified for certain kinds of surgeries. So the machines that are already sold get put to more and more and more use, and there's a lot of disposables that they sell. So the more uses and the more surgeries, the more money ISRG makes, and they keep replenishing. And then if there's enough use to keep a machine busy all the time, the hospital orders another one. It's a fantastic thing. And not only that though, but non-hospitals, because the whole point to getting the machine certified is the machine is effectively an operating room, and that's all you need. So you can be in the, you could be in the middle of the jungles in Africa and have an ISRG machine with a trained staff to monitor it, but the ISRG machine is your trained surgeon, and the surgeon from wherever he is in the world dials in directly and is able to operate the machine. So that's the guy who's trained to operate it. But meanwhile, now surgery can be done anywhere in the world without that kind of stuff. And I'm telling you, this stuff, it's going to eventually like be on cruise ships. It'll be like a normal thing. Like anywhere where there's large amounts of people, it's worth having one surgical robot to take care of X amount of people. That'll just be math. And if they do it intelligently, it's a great idea. Instead of just having a few hospitals that you can go to, there could be 10 trauma centers in a city where you can bring people to, closer, because you have the machine. You don't need the doctor to go to the hospital. You don't need the patient to go to the hospital. The patient can go one place and the doctor can go another place where you can operate the machine from. So anyway, it's a huge growth thing, and these guys are the by far leaders. But unfortunately, they went apeshit crazy in the last year, and they're kind of ahead of their skis. But will they grow into this valuation? Yes, they will. Anyway, all right. I talked about the watch list, very important to refer to. We had our stocks that were in our portfolios on May 15th. So in other words, on May 15th, I'm sorry, it wasn't May 15th. This is May 22nd. But on May 22nd, we reviewed every single stock that we cashed out that has been reviewed. So these charts didn't come out, but the stocks are here. And I'm going to be putting all these stocks onto the watch list. And that's what we're reviewing for. Should it still be on the watch list? BP, BP, move on for now. So don't bother with BP. I wonder if we had Jack in the Box. Oh, yeah. See what we said about Jack in the Box then. Jack in the Box, cautiously. Highly dependent on consumer discretionary spending, which is a concern in uncertainty, facing significant competition, inflation for operating costs. Any dividend is secondary to business health. The very low current price suggests significant issues are priced in. Could indeed be a deep value turnaround if they stabilize margins and traffic, which we're waiting to see. Minimum wage laws, labor regulations, and policies impacting consumer disposable income for food costs will be significant. All right. That's what we said about Jack in the Box on the 22nd of May. So every stock that we had in our portfolios is in here. And now we have to merge that into the watch list, which is extremely robust. Here's Jack in the Box. Just curious what we said about it. Jack in the Box had a punishing year. The stock is trading at multi-year lows. The company's challenges are multifaceted. The $20 minimum wage results have been mixed. The company's digital menu-driven innovations. Management is founded with Jack on track plans. It's kind of the same stuff that we just uncovered, basically, which includes closing the stores and restaurants. Dividend has been suspended to preserve capital. Strategic reviews underway for Del Taco, potential sale. So we knew all this stuff. Expansion continues. Despite these headwinds, Jack's valuation is now deeply discounted. trading at a PE of 10x and a fraction of its historical highs. The company's asset-light model. Recovery if macro conditions improve. Recommendations still watching. Jack in the Box is a turnaround story. The current price attractive entry point. It is prudent to remain on the sidelines until there is clearer evidence of stabilization or a successful strategic pivot. For now, it's a compelling watch list candidate, but not ready to accumulate opportunity for most investors. So basically, we're very consistent with what we said about it. Although it is now down more than when we said that, because it's crazy. It just keeps going down. So eventually, it'll hit a price that's so compelling we can't ignore it. But we want to see, we need more visibility into the turnaround plan. But anyway, so that's, you can see how detailed the analysis is on every single watch list stock. So that's where we are with that. So that's not what's in our portfolio, though. Let's see what's in the portfolio. So here's the money to our portfolio. We didn't change anything from last time, but we did gain, how much is it up now? We gained 60% since the last review. And that was not last review, since 3 months ago, the last time I was on the show in March, we've gained 60% in the money to our portfolio. So that's nice. So these are good, solid positions. And in the portfolio review, here's what we do. Okay. So there's our positions. T, I said, is on track. And here's what we expect to make. That we always put, I'm sorry, not always, not every review, but when I do a more detailed review, and right now the portfolios are small, so I'm starting out with detailed reviews, we talk about what's the upside potential of the positions, what's the upside potential for the portfolio. Because, and you guys, all this is really important. You have to do this because the upside potential, you have to know how much you're supposed to make on a trade. You should always have notes on your trades. That's what this is really. It's really just notes on my trades. Having a portfolio without a plan is pointless, right? Because you don't know why you did it. Why did I get into T? What did I expect to happen? Why am I in Lockheed Martin? What did I expect to happen? So here I'm like, okay, fine. We're looking, well, obviously you can look at the spread and say, okay, I'm looking for it to get to $470. I'm sorry, I'm looking for it to be over $470. It's at 470 now. So if it gets back to $500 and we do the roll, so we have a plan here to roll this lower, sell short calls, roll this low. We're waiting for it to pop a bit before we do this stuff. We want to sell short calls and then roll these calls to a lower strike. And then we believe we have a $16,000 upside potential doing that. Here's ARC B. And I said I strongly advise you to check this one out because it's net 950 on a $20,000 spread. There's $19,000 of upside potential on ARC B. What's that spread? It's very simple. The 70-90 bull call spread with the 75 short puts. And where are we now? We're right at 70. It's a 70-90 bull call spread, 2027. And with the $75 right here, short puts. And the net cost of the spread is $950. And it's a $20,000 spread. And we like these guys. We think they're, obviously we like them, or they wouldn't be in the portfolio. Here's Barrick Gold doing well. But you see how we know exactly how much money we expect to make on every single trade. So we have, aside from knowing if it's worth it, is it worth the margin we're using? Is it worth the cash we've got in the position? It's also compared to what? Because I've got this ARC B trade that has 2,000% upside potential, 20 times. So absolutely, you should have, you know, to not put $1,000 into this spread is crazy. And we should have several $1,000s in this spread, but whatever. And we'll see how that goes. But again, we have a new portfolio. This is a newish portfolio. We're not overdoing anything, but that should be in every portfolio. Oh, I know. I wanted to put that into the $700 a month portfolio. Oh, I can't because of the short put. So that's why. That one's utilizing short puts, which I can't really do in the $700 a month portfolio. But maybe the bull spread by itself is worth it. Got to look at that. Here's Barclays, 28% upside, but only 7 in January. So now I say, okay, we're going to make 28% in January, and now I got to go back at I'm sorry, I got to go down. So now I want to go down to the portfolio and say, okay, well we have $99,000 in cash, and we're not using a lot of margin in this portfolio. So we have $99,000 in cash. So there's no reason to, even though I'm only going to make 28%, it's just cash. All we would do if we cashed it in is collect $6,250, and that $6,250 is going to make 28% in 7 months. If I say, oh, 28% is not worth it, it's worth it. I haven't got anything better to do with $6,250. I've got $99,000 worth of cash. I don't need the $6,250 for anything. I may as well leave it in the spread and collect some interest, basically. And here's Foot Locker. Oh, and now in this case it's different. Foot Locker is $36,000. It's a $40,000 spread. We can make $4,000 more dollars. It's getting bought out by Dick's. So we could wait because we're going to collect the entire amount. So we could just wait until the sale goes through, or we can just cash it and have that money. So in this case, we're going to probably cash it out because, you know, we're not going to wait till the closing of Dick's. It could be 6 months, it could be a year, and I'd rather have the money freed up in that case. But that's going to give us a boatload of cash. Our cash is going to be our cash will be $150,000, $145,000. So we got to find some things to do with it for the next show appearance. I'm going to be on the show July 9th. So, you know, 1 week less than a month, I'll be on the show again. IVZ, 248% upside on IVZ. Nokia has 1,000% upside. No, I'm sorry, 100% upside on Nokia. And I said, great for a new trade if you like doubling up. It's like, and that's because the Nokia trade, we're in the money. We only played like the is it 5 or 50? Yeah, it's a $3 450 spread. So the spread that we have right now, it's the $3 450 spread with the $5 puts. We did a very aggressive put sale when we started because it made the trade, it made the spread a very low amount. We did a very aggressive put sale. We had a 50 of the $1.50 spread, so it's a $7,500 spread. And it is now only $37.40. So there is 100% upside even now. So we made money already. There's still 100% upside to go, and all it has to do is hold on to $5 because we sold the $5 puts. So you can take this trade right now, months after we went into it, and still make 100%. So also great for a new trade. Here's Ozark, 443% upside on Ozark. Pfizer, 785% on Pfizer, and Pfizer to me is like gold. And as I said, everything is going to plan, so it's great for a new trade. And of course, it's great for a new trade with 785% upside potential on Pfizer, which is a stock I'm not. And this, you have to weigh that into your decisions too. It's like I'm not worried about losing on Pfizer. They're not going to go bankrupt. I mean, it could happen. Like, you remember Tylenol and whatever, when people were dying. Something could happen. Anything could happen to anything. And that's why you don't go crazy. That's why you don't put your whole portfolio in it. But realistically, if we put 75,000, you know, whatever the amount is. What is this? 14,000 spread, 2,000 credit. Oh, this is a credit spread. Holy crap. Yeah. So it's a $2,000 credit with $16,000 upside. So why shouldn't we put 20,000? Why shouldn't we do a $20,000 credit and have $160,000 upside and just go on vacation for the year while we wait for it to mature? Honestly, there's almost no reason not to do that because it's freaking Pfizer. The only bad thing that can happen is we can be assigned Pfizer. But you know, with this kind of deal, why not? But that, you know, that's because this is a money talk portfolio. I only trade it when we're on the show, and I'm only on the show like once each quarter. And between that, we can't touch the trades. So they're all going to be these bulletproof, incredible trades. That's what this portfolio is for. But if you're trying to build wealth, isn't that what you want? Don't you want these kind of trades? So Signature Bank is Signature Financial, is that what it is? Yeah. It was actually our trade of the year. And people thought it was off, it was off to a bad, people thought it was a bad stock. We picked it up in November, and this is our trade of the year, and it went like that. So not good, but now it's recovered and we're fine, and we expect to make our 161% from here. Here's Target, good for 240% if it moves up. And here's Whirlpool, and this is another one I'm saying, this could be the whole portfolio. This position, there's no reason to do anything else. It's $3,800 on a $30,000 spread or whatever. It's a $30,000 spread. It's net 38, 26, is that right? Yeah, that is right. Okay, yeah. So it is 684% upside potential for Whirlpool. It's, you know, this is blue chip industrial Dow company. You only have to, what we're worried about is how they're affected by tariffs. But other than the tariffs, if they can deal with that, if their sourcing is good to deal with the tariffs, then there's no reason this thing shouldn't be double. Not double. I mean, the stock should double easily. And again, this is the upside potential. Not all of them work out, but if it only partially works out, we're going to be in fantastic shape. And here's Exxon. Oh, that's so crazy. We even have Exxon. What a diversified portfolio. I put an energy stock in there. You know, and a good thing we did too, right? So, and they fell off and they came back and blah, 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 whatever. But meanwhile, this range isn't that much. It's 120 to 100. It's a 20% range, and we're playing the middle of the range. So we don't really care if it goes down to 100 or up to 120. It's only 10% moves for us. We have a $20,000 spread. It's only $2,037. There's 881% upside potential if they hit 130 in 18 months. But they don't have to hit 130. If they only make it to 120, we're still going to make a couple of 100%. So overall, these positions, and I think there's only, you know, well, I don't know what the number is, but it's not many. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, about 16 positions. So about 16 positions here. And they're good for, and we only have, oh, that's not the right portfolio. Where'd it go? So we have $164,000, and these positions over the next 18 months have another $200,000 of upside potential. Plus we have $90,000 in cash. In fact, really, if you think about it, it's only $64,000 worth of actual positions that are going to make $180,000. They're going to make $200,000. They're going to triple. So that's pretty nice. The positions we have now are going to triple. We're also going to deploy some of that cash and build new positions that will mature into into 2028 when those options start coming out. So we still have money to take advantage of opportunities. We have money to make adjustments, and this is why we like to have like 50% cash all the time. Because if if you have 50% cash and the market collapses, so I have $64,000 worth of positions now, $99,000 in cash. The $64,000 of positions, if everything goes well, if the market goes up, we're going to make $200,000. That's plenty. But what's the most important thing? The most important thing is if that doesn't work out and the market drops instead and the $64,000 worth of positions turns into $30,000 worth of positions, at the $99,000 of cash on the sidelines makes a big difference, because now I can take 30,000 of that cash to double down. I'm not going to sit there passively and have a loss, which is in fact what we were talking about in that Jack in the Box position. He had he bought it at 35, so he had 35,000 worth of Jack. Now he's got 17,000 worth of Jack, right? Now, if I want to stick with Jack and I've got money on the side and now I can double down on Jack, which is what we talked about with the short puts, now my options are much wider, right? Because now I'm going to end up with Jack at so then I end up with my Jack in the Box at 17 plus 35 is 42, 52. Is 52 divided by 2 is 26. So now I've got Jack at 26. I don't need to get all the way back to 35 to get even, because I was able to double down, and not only double down, but I can double down, sell more options and do more short-term calls and short-term puts and bring in income and so on and so forth. Look at our arsenal because we're using options. Look at how many different things we can do, and because we have the cash. So in other words, if things go well, we're going to make $200,000. We're going to make 124% overall in the portfolio. If things don't go well, we're in a great position to recover. That's the difference. If you overextend, then, if we overextend, if we're greedy, if we try to make 300% or whatever on the whole portfolio instead of having a good amount of cash, it's like, yes, if everything goes well, we'll do phenomenal. But if everything doesn't do well, we don't have the money to get out of it. We'll take the hit. And the worst thing you want to do is take the hit. This is what Buffett says. Buffett's rule number 1 is don't lose money. Buffett's rule number 2 is see rule number 1. That is his whole investing philosophy, is always make money. Do not lose money. And do not lose money doesn't mean cross your fingers and pray you don't lose money. Do not lose money means you will fix it. You will do something about it. When you think you're going to lose money, if something changes, or before you even start the position, don't pick a position where you think you might lose money. Don't flip coins. All right? So in other words, we look at the next portfolio. We have a hedge in this one, the SQQQ. We look at Trox. Trox is losing money, so that's a shame. That just went the wrong way on us. But Blackstone, Newtek, ET, Levi, PEF, VFC, HP, NAK. Well, that one's doing really well. B is Barrett Gold, Macy's, SoFi, UUU is Rare Earth, Valley. They also burned us. There's 2 that burned us. Is Valley. So we did get burned on 2 of them. It does happen. But the point is, we think all of these are good, solid, logical choices. And on the whole, despite being burned on a couple, we're up 112%. I'd say in 2 years. So that's our $700 a month portfolio. Very conservative, very small investments. Being conservative didn't stop us from losing a lot of money. But we still think that long term we have a chance to recover on this, and we're going to have to, we're up enough now that we may make a decision, but we don't have a lot of cash, so we're kind of wary about adding anything to this right now. But I do want to move this to, oh, we already did. I'm sorry. These are the old ones we got burned on. These are the new ones. This is a new trade, and we are hoping it will start recovering and hopefully even recover enough where we don't lose so much on this one. So we've already done something about it. This is our new short-term portfolio. Oh, I have to stop somewhere because I run out of time. So here's our main hedge is SQQ. We also sold some short Apple puts because I'll take $14,000 for promising to own Apple at 175. I have no problem with that. And then the long-term portfolio, MP Material, Pinterest, ERJ, the jet company, iPath, Teradyne, UU again, I like them a lot, and Whirlpool, of course, because, oh my God, what a freaking great trade this is. So, of course, I replicated it over in the long-term portfolio. And again, we're calculating the upside potential. So in the long-term portfolio, we've got 400, we've only used $50,000 worth of our cash. We have 458,000 on the sidelines. Yet these trades, because it's the same thing as the other portfolio, these trades have $200,000 worth of upside potential. That's 200,000 on $58,000 worth of cash trades. And we have 450 on the sideline. Now, again, it's the same concept though. I'm not going to replicate that. I'm not going to take all the cash and put 10 times more money on that so that we can make 1,000 million%. It doesn't work like that. It's the aggressive positions with the cash on the sidelines is the winning formula, because year after year, adjustment after adjustment, we can find ways to win because we can afford to make those adjustments, because we can afford to double down, because we want more of the positions. All right, so that's that. And I'm just gonna, what is this? This is briefing. This is not Bloomberg. There it is. So we had, so it's 2:30. We're gonna do an update. And now I'm gonna feed Warren what's left. This is very convenient, right? Here we go. Okay, and now we just tell Warren. Some more, but the conference is still going. Oh, and the Dow is now negative. These comments have not been going good. Whoa. Oh no. All right, I'm going to publish this, so don't worry about it. I interrupt him if he's okay. That's what I'm curious about. You're reading the mood perfectly. Let's break down why the markets have turned red into the close. The Fed is on hold longer than hoped. Powell kept 2 cuts on the table. His tone made it very clear, no urgency to cut. We are well positioned to wait. Inflation is sideways. The door is open for cuts, but only if data shifts meaningfully. That's interesting. Oh, people couldn't like that. September cuts are not guaranteed. That's what killed it. Tariff pass-through is still looming. He spent significant time emphasizing the tariff inflation hasn't hit yet. We're seeing early signs in goods prices, and they expect more over the summer. We are flying blind on how much inflation will accelerate. Investors don't like unquantifiable risks. Deep division. The dot plots show growing divergence in the Fed. 7 C0 cuts, 8 C2 cuts, only one shift would change the median to just one cut. So he's digging deeper into the data. Global and domestic policy uncertainty, Trump's ongoing trade threats, immigration policies, new tax proposal unresolved, Middle East escalation risk remains lurking. Biden-Trump debate cycle begins. Biden-Trump debate cycle begins. What? He's hallucinating. See, that's hallucinating. I don't know where he got that. Markets are closed tomorrow. This creates anxiety. Traders are de-risking ahead of 48 hours of headline exposure with no liquidity. Don't want to be long into a market with a high headline risk. Policy, purgatory, stagflation, Powell, modest growth. There's mild stagflation, narrative building, growth slowing while remains above target. The Fed may not be cutting soon. Inflation may rise before it falls. The path is highly uncertain. Powell is very comfortable waiting. That leaves us exposed to a highly binary summer ahead. Stay defensive into Friday. There's still headline risk on China, the Middle East, or even the Fed. Watch for tariff data starting to hit consumer prices. Oil staying above near or above 90. That's also. Labor market softness is increasing. Corporate earnings revisions for July. See, this is usually stuff I would correct him with and say, hey, this is that, but we don't have time. Earning option premium income opportunities, and we recover call spreads. Hedged options include strategies. If you like, I can prepare some. That's actually kind of fun. I wouldn't mind that, except I don't trust him to do it because he's hallucinating. I think poor Warren, this particular session of Warren has run its course, I imagine. Anyway, so thank you everybody for coming. I'm going to put this into a more organized thing and put it up at PSW. And we will do this wonderful webinar again next week, all right? So take it easy, everybody. Oh, wait a minute, somebody had a question. With the tariffs in July, what is your favorite sector in the market? I don't know. I'll tell you that. I was looking at throwing some money into ITA ETF shares, aerospace and defense. You know, it's not about saying, oh, aerospace will do well or defense will do well, and I would stay out of I certainly stay out of Boeing for now. But it's about, you know, are they currently a value? So, you know, we're gonna like somebody if they're still cheap. If they're trading at 30 and 40 times value, I don't want them. I don't care what it is. It's, you know, you can't just say, oh, they're aerospace, oh, they're this. I need to find individual stocks that have a value. That's what our whole portfolio exercise building is all about. So, you know, stick with us. We'll be going through a lot of things. Like I just said, we have these lists. So take a look at those lists and see what's on it. You can like a sector and see what we think about something in a sector, but I wouldn't buy something just because, you know, we might have a war and therefore aerospace. That's not a good reason to overpay for a company. All right, guys, thanks so much, and talk to you again next week. Thank you.